Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Resilient market surprises nervous investors. Well, stocks have been grinding higher this month, surprising many investors who were expecting a pullback to begin the year. The S&P 500 is up roughly 5% thus far in January. Now, consensus narratives heading into 2023, which is what most economists, market forecasters, and pundits thought, was that the first half of the year would be challenging, followed by a recovery in the back half of the year. Now, while that's certainly possible, the market rarely goes according to such a nice and neat predetermined plan. Perhaps the opposite of the consensus narrative could be true. The market starts off strong, followed by a weakening in economic and market trends as the year progresses. Now, the good news, at least we hope, is that regardless of which forecast turns out to be true, stocks and bonds should provide some yin and yang for portfolios like they're supposed to do, as opposed to both moving in the same directions like they did last year, which was obviously lower. Now, if the economy holds up and stocks do well, bonds might struggle a bit, but if the economy deteriorates and stocks underperform, your bonds should do their job in 2023 and provide some balance and diversification benefits. For this week's featured insight, keep your emotions in check. So humans are emotional beings, right? Strong emotions like fear are helpful if you're being chased by a dangerous animal and need to escape, but they can be extremely problematic when it comes to good investment decision making. Most investors tend to buy when they feel good, which is usually when markets are rising or have risen, and they sell when they feel fearful, usually when markets are falling or have already fallen. Now, everyone has heard of buy low and sell high, but most investors are actually prone to do the exact opposite in practice. The key to avoiding this problem is to create an investment plan that you can execute regardless of how you're feeling. Dollar cost averaging, which invests a certain amount of money at specific time intervals. For example, you put $500 per month every month into an investment portfolio. And also periodic portfolio rebalancing, which resets your portfolio to target weights for each asset class, selling the outperformers and buying the underperformers, will help you to avoid making mistakes based on emotions. Looking ahead, Fed on deck. Yep, yet another Federal Reserve meeting is upon us. Next week, our central bankers will likely raise the short-term interest rate they target by 1/4%. Now, that's after a series of very large 3/4-point interest rate hikes last year. The Fed raised rates then by 0.5% last month and is again likely to reduce that pace of its monetary tightening with only a 1/4-point hike this time around. Now, the good news for borrowers and equity investors is that the pace of hikes is slowing. The bad news is the Fed is still hiking, despite signs of an economic slowdown in progress. Now, while we're all hoping that the Fed can cure our inflation problem without causing a major economic downturn, the full effects of the tighter monetary policy have yet to be felt. Investors should continue to proceed with caution. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.